Hi everyone, this is the 26th of September 2016. We just closed this week positive for the market, forming what technicians would call a hammer candle, which can sometimes be associated with the bottom. Now, the only question would be whether it would be short term, medium term, and how long it holds out, but shows some near-term strength from what has been, a 3-month-long selling spree in the market because we actually peaked in the first week of September. And this sell-off, what it has done is it goes into confirming that my view that the entire move up from the Feb lows was essentially corrective in nature and not impulsive, even though we saw small and mid cap indices move up to new highs. We did not see that in happening in Nifty, and that's what we call a classic intermarket divergence, something that goes right back to the original work by Charles Dow, where he studied, intermarket divergences between various Dow indices to look at confirmation as to whether a long-term trend was continuing or whether you were likely to get a reversal. So whether the reversal was actually being confirmed by other indices or not, and whether there were divergences. And that's the so it's really classical, and this is essentially one of the longest intermarket divergences I've seen, at least on the Indian market. We've seen smaller ones lasting couple of months before, many times, but this one was really extended because it's like almost over a year that you see this having developed. And because of the steep sell-off, there's no more way that you can actually continue to try and mark the entire move up from the Feb low of this year as an impulse. So basically, that goes to say that it was counter trend in nature. So that having been done, we are a couple of days into what would be the end of month closing, and that would give us further clues in terms of how far we can go on an immediate basis. So we'll be looking at that. And What's really interesting is how far down are we going to go and how long is this going to last, because this is event related. Some people would like to argue that if it's only event related, then it's discounted and then things would revert. But note that the market actually peaked in September. These events have only led to an exaggeration on the downside of the pace of the sell-off, and in that sense, this was an early peak. You may also argue that, oh well, that peak was essentially because there were a lot of events coming up like the US elections, and the result of the US elections essentially has been that while the US market has actually rallied, which does not surprise me as it may have surprised many others, because if you simply heard to what Trump was saying, he was talking about cutting taxes and reducing regulations, etc., etc. And I was telling my team, well, whatever he's saying is not really bad for any market. Say, for example, you are saying that I'm going to come to power and cut taxes tomorrow. Would the Indian markets go up or go down? And that should give you the answer. But all the media and all the people out there were essentially putting it in our head that if he's elected, then markets would go down. But essentially, a lot of what he was talking about was bad for would be bad for other markets because of the trade agreements that would impact individual ones as and when they change, rather than the US itself, and which is why you've actually seen a long US and short EM trade, which was more logical, rather than expect that the US itself would also sell off on his election. So that's the essential point. So that was not a surprise, but the US market itself has rallied long enough. It may not be in extreme overbought on a sentiment basis, but definitely a couple of indices are seeing their RSIs trade into overbought conditions, and we are waiting to see where that reverses, because what we are seeing between the Dow and bond markets and between the dollar and gold markets, each of them are reaching at sentimental extremes, and it's happening all at the same time, which makes it very, very similar to what we saw at the start of 2016. So it's critical. You need to watch how those things go. Everybody is, I think, extrapolating into some of those trends. For example, if you think about the rising dollar, I think they're extrapolating into what happened in the past. I mean, how many people say that the dollar went up in 2014 and 15 because of expectations of higher rates? Well, rates went up only 25 bits, and at the end of that period, So it was not rates that was attracting money into US markets, because rising rates would mean lower bond prices. Would you go there and buy bonds? So the reason the dollar rallied in that time period, if you've studied it closely, was not because something was happening in the US, but it was Japan that had taken the lead to actually weaken its currency to actually stimulate the economy, and the same was being done by Europe through quantitative easing, which was raised and increased in size. And so that essentially meant that both of them were devaluing their currencies, the euro and the yen, which form a significant component of what is the dollar index. And so the dollar rally of that time period was essentially related to the weakness in other currency pairs. So right now, once again, when they're rallying, people are just extrapolating past reasons as to why the dollar must go up, and which is why I feel a little concerned. Sentiment is at a super extreme. It's trying to break through the 100, mark, which it has done. But on a long-term basis, I've written some time back to subscribers about the 8 to 9 year cycle on the dollar, and we are fag end of that. And also, if you just take a simple retracement from the 2001 high to the 2015 bottom, 2008 bottom, 2001 to 2008 bottom, the retracement 61% is at 102, and so that's where you are. You're very close to that number, and that's a very important retracement mark for technicians. And so you'd be watching that number and see how it does. And I'm not talking about point 0.1, point 0.2 moves above or below that, but watch how it really behaves there. And so the same is with many other markets. Bonds have really broken down seriously. This does not look like uh, move that is small. In fact, you have this massive intermarket divergence between even the 10-year and the 30-year. So the 10-year actually peaked in 2012, and when we got the taper tantrum, and Indian bonds sold off, and you've really not gone above that high on the 10-year, but you did go to an all-time high on the 30-year, and that's caused an intermarket divergence even between the 10 and 30-year US bond yields. And so it was an important top, and you saw a massive sell-off. But again, there you're significantly oversold. The RSI is down to 16. So basically, you have many of these markets which are running at extremes, and that can quickly change, and would have a direct impact on what happens across each of these assets. It would probably happen simultaneously across all of them, which would make it really, really interesting in the near term. So that's as far as the world markets are concerned. But then again, coming back to our own market, we've diverged, we've sold off, and we've had our own domestic reason. Now, if you just delve into that a little bit, my sense is that, anyway, calling this a bear market rally means that once you started falling, this downtrend should last for several months, maybe 12 to 18 months. Now, the debate goes on as to the economic impact of this, because a lot of numbers would only come out after a month or two. But what you'd say is in general accepted is that yes, there's going to be a more than a 1% impact on GDP. So any economist would probably agree to that. Recently, a number was put out by one of the broking firms indicating a more than 3% impact. Some people call that too much, but I think even if you say anything between, because 1% is conservative, if 3 is too much, let's say even if it's 2%, it's a pretty significant impact that you're looking at taking place in the first quarter of the coming year. So that's going to be immediate. And then by that point of time, we're going to try and figure out what's going to be the consequent impact of what has happened, because how much money is really going to be lost in the system? Is it all going to be turning from black to white and then again be withdrawn from the banking system? If this money is withdrawn again, then the jump in bond yields might just be a temporary phenomena. Second, if that money doesn't come in, then yes, then there's a lot of money loss that is taking place by people who are hoarding, and then that loss causes an economic loss in terms of future activity, and that number can completely vary based on what actually ends up happening over the next quarter. And even if it is all converted, would it be converted through paying taxes, or would it be converted through multiple accounts? How much really comes in clean, and how much does not? Does it all go back to business as usual? Definitely, it can't be business as usual. There will be some downward knock, because either you would have lost on cash holding, or you would have paid a tax. or you would have paid a tax on some component of what has happened, and you'd also become careful about the future. Another thing that could happen is people might want to withdraw and hold more cash, or they might want to hold money in other forms, in the form of maybe gold or real estate all over again. So there could be this differential impact. It may not happen right away, but it will happen over a period of time. And so you need to look at those possibilities as well. But essentially, it means that at least for the next year, you have an earnings impact, and that's what matters to markets. You haven't had earnings growth for almost uh, I think 6 quarters, similar to the US. US has also not had earnings growth for 6 quarters, which is quite amazing. Both of these markets actually continue to hold out despite that, because the focus essentially was not on the macro, which is the average, what all the index companies are doing together, but those couple of sectors that are probably holding out against the others, which was also the case in India. Mid caps, small caps, some particular sectors doing better than others. So analysts report earnings on an X financials basis or an X IT basis, and then say, well, things are still looking good. But essentially, it was just 20% of the say Nifty stocks which was driving earnings. The rest of them were not, and on an average, we were actually seeing a decline in the earnings front. And now with this event, you add another 4 quarters. So when you and it's actually going to hit some of the sectors which were the high growth sectors of this time period, whether it was private banks and NBFCs. The business models are all getting turned upside down, whether it's two wheelers and so on. So if these are the guys who are going to take a hit, these are also the guys where all the money was flowing into through SIPs and mutual funds, which is the route that small investors and individual investors took this time rather than directly participating in the market. So when people ask, has there been participation by retail and by the public at large in the markets? They did, but this time around, instead of direct market access or FNO, they were actually choosing mutual funds, portfolio management services, or SIP. And a lot of that money went into these sectors, which were essentially higher growth and small stocks. And since those are the sectors going to be taking a hit, the average PE that we are paying for the index for actually no growth on an average had crossed 20 times, gone almost to 25, 26 times. It's back to some 22, 21 times with this sell off. And on a historical basis, that's still high. And the last argument you can come up with is, well, interest rates are going to go down, and therefore, you might not really go to the lower end of historical valuations. That's not how markets have ever worked in any market around the world over a 200 year period. You study any market over multiple cycles, they always complete cycles. But then think of it this way: all the money that's deposited into banks, a lot of it is going to get withdrawn. So the demand you're seeing for Indian bonds is essentially domestic. You're already seeing an outflow from foreign bonds, foreign money that come into Indian bonds. In fact, I partly consider, while the steps taken by Raghuram Rajan to bring in that money, stabilize the situation, it only reduces volatility, not the direction. And he said that himself. And essentially, what that means is he brought in a lot of money into the Indian bond market, foreign money, and really created further foreign risk. That as and when the interest rate spreads between the domestic and international interest rates come down, then these bond investors actually, fresh money actually stops flowing into those into that segment, because they don't get that spread. So the fresh flow moves stops happening. And the second is, when you get currency risk, as you're getting right now, when the currency moving the other way, then the existing investors actually start getting scared and looking for an exit. And if interest rates starts going up in the US, then they'll probably look at alternate places to actually go to. So these multiple reasons why you would actually start seeing foreign money move out of the Indian bond market to some extent. And depending on whether the situation continues in terms of weakening currency, rising interest rates, you'd get further flows out from there. And the recent bump up in yields only on the back of deposits would probably stop happening in a month. So you'd see a reversion of the yield chart. Even though RBI may cut rates short term, I don't know if they will, they won't. They probably will have to chase the market at this stage. But they might have to, revert all again if they overdo it, once the yields turn the other way or the currency breaks past the 69 level, which can be debated as a double top, or but if you really break past it, then it's unlikely to stop very soon. So that would cause another headwind. Essentially, that the bond market interest rate logic and would probably get relooked at in the coming weeks and months. Of course, note there are two perspectives. One is what happens near term on the rate front, and second is what happens longer term. Now, if I consider my economic winter cycle view, then definitely once you're into these final stages of this cycle where you actually rewriting all the NPAs debts, writing it down, or inflating the economy at that point of time, or after that, you'd essentially see a drop in Indian interest rates, because the long term, I think interest rates in India have peaked in the mid 90s, and from there they fell all the way into 2002. From there, they've been in a range, mildly trending upwards, but mostly in a range between 9 and 7%. And once this range breaks, it will probably break on the downside. But till that time, we are still within this range. You'll continue to see volatility on both sides, and I've maintained my expectation that you can always see volatility going back to the upper end of this range, which remains an open case till we've completed this corrective process, and we've actually seen our bond markets adjust to the excessive flows that we've taken in, and also to the NPA problems really being taken care of, after which I guess due to the lack of credit growth, and once you've taken the hit for the past mess, rates will naturally come down, because then you'd have adjusted your cost of funds downwards through the new funding and write-offs. So that's the perspective that will happen eventually, but in the near term, you're still exposed to interest rate risk in the market. And you're also exposed to inflationary expectations, because, like I said, if the dollar is the primary driver of that, and you're at a point where it's at an extreme, everyone's extrapolating into the future. And if you're only looking at gold prices and saying that no, this won't happen, then you're probably not looking at what copper is doing, what soya bean is doing, what many other commodities have written. I think all about a lot of agro commodities this week, which again started trending up after selling off in between. And metals by themselves are reflecting a big move. Even copper, which was the most beaten down, has actually managed to turn around completely. So I think there are lead lag effects across these commodities, essentially based on their individual issues. For example, crude still facing an OPEC meet, but if it's a question of survival, eventually they would probably come up with something, whatever that something is. And at that point of time, you'll probably see prices stabilize here and then head higher, because then there would be, the downside would at least get capped. And so similarly, we are seeing that in base metals, and you'll probably see it at some point in precious metals. And so essentially, you're looking at, and also agro. So you're looking at inflation picking up at some point of time, interest rates being at risk, and that's taking a 6 to 12 month kind of view. In the near term, though, because of our own contraction, we actually get some kind of deflationary effect. So we're already seeing low credit growth for this quarter or the next. We'll see a drop in GDP and so on. Anybody who would look at those numbers would say, well, this economy is contracting, but then these would be temporary effects. Then base effects will kick in. But what you can't know is behavior, and that's why it's so interesting, is that economics is basically, and socionomics, the extension to Elliott wave, is all behavioral science. And the reason it's behavioral is that an economy moves or turns essentially on the basis of human behavior. What are the public going to do? Are they going to keep spending? Are they going to save more? And while we are not getting a lot of investment happening all over again, while the investment cycle picks up, what we've really hit this time is the consumption cycle. And we'll have to watch how consumers in general behave through this cycle and this trend over the next 6 to 8 months. And that allows for corrective time to go back to more logical valuations. If you're not going to be having earnings growth, you haven't had it for 6 quarters, you don't have it for another 4, then are you going to continue to pay 22 times earnings, is what you need to think about. And definitely be prepared for looking at good valuation buys wherever that is possible. So that's the outlook. Those are the concerns and things to watch out for. And I'll continue to be writing and publishing levels, views, and I think this monthly close, like I said, will give us further more insight in terms of where we are headed more on an immediate basis. and the global headwinds continue because we have, of course, many events coming up in the month of December which are more global, and so you're going to be paying attention to a lot more of that than just our domestic issue, which is now already out in the open. So that's it. Thank you, and that's all in this update for today.